Sometime in June 2025, I've had an epiphany to incorporate things I learned from work and apply it to my trading journey. So I decided to code a base XGB model to try and predict stock prices. Please check it out if you haven't already. I will share the link to my first video on screen and in the description box as well. Before we start, I would like to put a disclaimer that this is not a solicitation to buy any financial products or investment, and is just a sharing of my learnings. With that out of the way, let's begin. Since the initial model looked decent enough, I decided to incorporate it into my trading strategy. I used it to trade for 3 months from July 2025 till September 2025, and I will share my journey in this video. But before I start, what is my trading strategy? I trade the weekly 5DT, or 5 days to expiry US stock options. Simply put, every Monday morning when the US stock market opens, I will open option positions with expiry due at the end of Friday for the same week. But how do I make money from this? Well, I sell option credit spreads. I won't go into the finer details of what it is, but simply put, it is an options strategy where a trader simultaneously sells a higher premium option and buys a lower premium option of the same type, both calls or both puts, and expiration date. The goal is to profit from the net credit received, which is the difference between the premium collected from the sold option and the premium paid for the purchased option. Assuming everything works out, I should receive money in my account at the end of each week. But wait, the model I developed predicts stock prices, but I trade stock options. Where's the link here? Good question. Stock options are based on the underlying stock prices. The model predicts stock prices, and based on the predicted level, I will buy and sell options accordingly based on the predicted price, with a margin of safety price level away from the predicted price. Yes, the final decision and action to buy or sell is still done by me, and there is still human involvement in the process. Since the margin of safety price level is not predicted by the model, it is still up to my discretion to determine it. So the final decision to buy or sell is a combination of machine and human factors. Also, the model features have changed quite a lot since then. When I first started, the model had only 11 features. But over the course of 3 months, I have incrementally coded and added features such as price movement and momentum indicators to train the model. As of now, my model has more than 50 features. So, how are the results like thus far? Well, it's not looking too good. You can see the screenshot of my 3 months P&L from July to September. It started okay, but ended badly. I made money in the first 2 months, but suffered massive losses in the final month. You might think that the model is performing badly, but that's not really the case. I've kept track of the trades I made, and here, we can see that I have actually achieved an 82% win rate. So, what happened? This is something I would have to reflect deeply upon. For now, I would chalk it up to a bit of a gambler's mentality, with no self-discipline and no risk management. So far, it has been a rollercoaster journey with ups and downs. It has been incredibly humbling for me so far, and I would like to share some things I have learned along the way. The first thing is to code as many features as possible. With more features available, the XGB model will be able to learn more and have more data points available to make a better informed prediction. Of course, we don't just put in random features. The features need to be good quality ones as well, such as different volatility measures, price movement measures, etc. So I spent quite some time on the internet researching and studying some of the trading indicators before I coded them. The next thing is to use the model to predict and ultimately trade different stock tickers. You may have a favorite stock ticker and hope that the model will do well in predicting the stock price of it consistently. This scenario rarely happens. You have to apply the model to different stock prices and select the prices that you are comfortable with. The features used to train the model may have different contributing values depending on the stock ticker being traded. As such, you should have to trade on different stock tickers, and not just on a single stock ticker. This also leads me to my next point, which is to diversify risk. When I trade each week, I do not trade only a single ticker, but I trade a portfolio of stock options which will expire at the end of each week. This will help to diversify the risk and reduce the standard deviation of my profit and loss. While it may cap my gains, this will cap my losses as well and help to ensure longevity of my trading portfolio. However, not all option premiums are the same. So what do we do? That also happens to lead us to my last learning point, that options trading have asymmetrical returns and risks. It is asymmetrical in what I see in two ways. First is the portfolio level, and the second is on the individual stock option risk. What do I mean? On the portfolio level, say you have a portfolio of 2 stock options, A and B, which are due to expire at the end of the week. Stock option A yields you a premium of $70, and stock option B yields a premium of $50. This is what I mean by asymmetrical return, that not all stock options spread traded will give an equal premium amount. As for the individual stock option risk, the premiums and losses of stock options traded are not like what you read in textbooks. They are not equal. For instance, reusing the previous example, say at the end of the week, if stock option B closes with a loss, it doesn't mean that its loss is capped at $50. It could be 70, 100 or even more depending on the volatility and market conditions. Hence, the profit and loss for an individual stock option are not mirror images of each other and thus, asymmetrical risk and return. However, if you trade a portfolio of stock options, you can spread out the risk. Referring to the previous example again, say stock option A nets you a premium of $70, but stock option B closes with a loss of $100. In the end, you still have a net profit of $20, but you would be worse off compared to if you only traded stock option B. By having a portfolio of options, you can reduce your risk across different options. Unfortunately for the asymmetrical risk stemming from individual stock option, I do not have an answer as I am struggling with it, and I am learning how to manage it at the moment. If you have any tips, please feel free to share with me in the comment box below. All in all, I think the model performance is pretty decent. Going forward, I will continue to use the model to trade and incrementally add features to enhance the model. Ideally, the whole process should be automated, from making trade decisions and risk management, to remove the weakest link in the process, my human input, bias and emotions. However, at the same time, the human touch is also the key to the system's success. In the meantime, I will continue to learn and improve my risk management. I will also detail and provide updates to my trading journey every once in a while, and hopefully, if it improves, I might even expand to use it to trade other products such as shares from other markets, or FX, maybe even cryptocurrencies. Do you have any thoughts on it? Feel free to comment in the comment box down below. If you liked this video and would like to see more content of this nature, please be sure to like and subscribe as well. Thanks for watching, and until next time.